Carr will be along at the bottom of the hour. But right now we have a repeat guest, and that is Stephen Patterson of KeyCityCapital.com, one of our great sponsors. Go to KeyCityCapital.com/Hugh. I check in with Stephen or someone else from Key City Capital every month because rents matter to everyone every month. Good morning, Stephen. How are you?
Good to see you, Hugh.
Always good to see you. I want to read to you the first paragraph of the latest news release from Building Design and Construction website. Quote, multifamily rents rose for the fourth month in a row, according to the May 2024 National Multifamily Report. The performance of the multifamily market continues to ebb and flow after 5 months into 2024. Steady growth is present, however, mitigated by the rapid delivery pipeline in many markets, states the report. Average rent almost up to $1,750, Stephen. What is it where Key City Capital owns? What's the average rent in Texas and Tennessee and Florida?
Yeah, depending upon the class of property, Hugh, we can run anywhere from $1,100 a month up to as much as $2,200 a month. So it's all relevant to location and age of property. But really, if you get down to what's driving rental increases right now is homeownership has just become unaffordable. For the first time in 40 years, it is cheaper to rent than it is to own. And that has a large part to do with 7.5% mortgage rates, property taxes that have skyrocketed. And then the great unknown that everybody's dealing with across the United States is insurance costs. And so when you put all those factors together, renting just makes sense. And a large portion of the U.S. population has been, at this point in time, blocked from home ownership due to pricing.
I want to talk about the pipeline in a second, but I have to do my disclosures. Not only is Key City Capital a sponsor of the show, I'm an investor in it. And you can't get into the fund that I belong to and the Fetching Mrs. Hewitt belongs to because we invested 2 years ago. But if you are an accredited investor, and you have to be an accredited investor, and you want in on this kind of investment as a passive investor with no risk beyond that which you put in, you go to KeyCityCapital.com/Hugh. The minimum investment is $100,000. How is business, by the way, Stephen? Are people still piling in?
Yeah, no, business is very good. What I'm seeing right now and the discussion we're having with lots of clients is stock market is at all-time highs. And so now is a great time to take those earnings and diversify the portfolio. You don't want to diversify when the stock market sells off. You want to diversify when the stock market's peaking. And right now we've seen tremendous run-ups. I mean, yesterday the Dow closed around 39,000. What was it? 2-3 weeks ago, it hit 40,000 for the first time. Now's a great time to take earnings and diversify in limited partnerships like what we offer. It gives you a new class of exposure with house money, if you will, because you're using earnings, not principal.
I think the word I use most, I don't give financial advice, but I do tell people that the financial advice they'll hear most is diversify. So when my gold sponsor says diversify, they buy gold. And when my stock people come on, they say diversify, it means portfolio. When people diversify into KeyCityCapital.com/Hugh, what are they buying, Stephen?
Yeah, this is what makes us attractive is they're buying into a hard asset. People understand real estate. It's there. It's physical. You can see it. I have very few clients that I've ever met that can explain to me why Apple hit $200 a share yesterday, right? Or why NVIDIA has skyrocketed at the rate it has. But people understand why real estate appreciates. People understand rent growth. And people understand that type of distribution model. And so getting into a physical asset that is tax advantaged, meaning we can capture depreciation on this to offset gains and give you a tax break while you're earning, I think is just a huge plus. And for the accredited investor to look for diversification in a real estate asset just makes a ton of sense. And so we sit down, we'll have a conversation. I'm a licensed financial advisor. We can sit down, take a look at your portfolio, try to make an appropriate decision for your age and your risk profile, and give you a diversification so, things do not go up in perpetuity. right? The stock market's hitting highs. It's not going to stay there. Real estate hit highs. It doesn't stay there. It moves. The way to protect yourself is to be across multiple asset classes so that you can capitalize in these key moments.
So I want to go to this report, and it says mitigated by the rapid delivery pipeline. Now, I want to translate for the audience what that means. That means that apartment rents will go down if more apartments are built. Well, I don't know about that, because if demand is way oversupply, you just narrow the you narrow the gap, but the rents don't stop going up, right?
No, they don't. And Hugh, let's talk about just some basic math for a minute. KeyCity focuses in the Sun Belt states, right? So let's use Texas as the example because our last few purchases have all been in Texas. Texas has 360,000 people a year move into it from the contiguous continental U.S., right? That's before we begin to discuss the southern border, and we already know what's going on down there. And I don't think anybody has a handle on what that number is, right? But just, people inside the U.S. moving in from California, Pennsylvania, New Jersey, blue states that are coming for low taxation and a premium on high personal liberties. Texas has been a model for that. Florida has been a model for that. And so when you have that type of move in, the demand doesn't slow down. And candidly, 50% of the mortgages in the U.S. were refinanced at lows at 3.5% or more. So those houses aren't coming on the market because people don't want to go into a 7% mortgage. So therefore,
now, we used to talk about people who refinanced at 5% down to 3%. Well, the people who have 5% mortgages aren't going to refinance now either.
And they're not selling, right? They're not going to sell to move around the corner to that bigger house. And they say, oh, well, let's go ahead and upsize, but now you've got a 7.5% mortgage. It's not going to happen, right? So housing supply remains tight, which puts the prices sky high, and it makes rental real estate a premium, specifically in quality multifamily. And
so the one question I never get to, Stephen, and again, get the prospectus, read it before you invest. How long does people money stay in one of the KeyCity Capital funds if they invest right now in your open fund?
Yeah, it's a 4 to 5 year profile. So principal remains for 4 to 5 years while we're growing the asset, we're capitalizing on that appreciation and creating rent growth. So it's not you're in for 6 months and you're out. It is a longer term investment with the tax advantaged upside.
No, but it's 5 years. That's a good number for people to think about. They're not going to move their money in and get it out. It's going to be there for 5 years.
That's correct.
Stephen, KeyCityCapital.com/Hugh. People offer you their information. Who calls them back?
Yeah, it's either me or my assistant. And there's a link on my website where you can schedule a meeting. You can see my calendar. You can see what's available, and you can schedule a meeting at your convenience. I'll hop on a Zoom call or a phone call with you and discuss your situation and whether or not we're an appropriate option for you.
KeyCityCapital.com/Hugh. Keep that pipeline going, Stephen. The country needs apartments because, boy, oh boy, it's not getting cheaper out there. Good to talk to you. KeyCityCapital.com/Hugh.